Today we start a two-part topic, which is called time value of money. And this topic is kind of the foundation for everything that we are going to do throughout this course. Last time, we agreed that the main goal of stockholders is their wealth maximization. You voted for this, and we agreed that this is the main goal for everyone who buys stocks. How exactly this wealth is measured? So in finance, it is believed that the wealth of shareholders is measured with the current stock price. The higher stock price is, the wealthier you are. Seems to be logical. Last lecture, we also agreed that the current stock price depends on several factors. One factor is the expected future cash flows, the size of expected future cash flows. And these cash flows can exist in two forms: dividends or future price. If in the future you want to sell your stock, this is also the source of cash flow for you. Another important factor is risk. How uncertain is the future? Because we are talking about expectations. We cannot guarantee, no one can guarantee you the size of future cash flows. For some investments, this is more predictable. For some investments, it's less predictable. But still, there is no 100% certainty about the size of your future profit. And the higher the uncertainty is, the more risky is the investment. And therefore, the stock price will be okay. So this is the question to you. If risk increases, what happens to the stock price? If the risk of your investment increases, what happens to the stock price? Logically. Come on, guys, this is very simple. If the risk of your investment, if the risk of a company, if the risk associated with the stock increases, what happens to the stock price?
It decreases.
It decreases, of course. You are not ready to pay for something which has large risk. I guess this is logical. And we are not inventing some rocket science here. This is a common sense. I'm not willing to pay a lot to invest a lot of money in something which has a poor perspectives. Okay, now regarding these determinants of a stock price. Suppose we have a company, we have an owner, this owner has some shares, and there is a potential buyer, a person who is willing to buy these shares right now. How much this person should pay for these shares? As we agreed, it depends on the future profit which the company is going to pay to this owner. Very important thing, this future profit is not known and nobody can tell you what is going to be this future profit. which means that we need to build some kind of estimates of this future profit. So how these forecasts are made, this is not a question of financial management. Soon there is gonna be another course on my channel, which is associated with financial risk management. And if you are interested how the forecasts are made, you are more than welcome to watch that course. Here in the financial management, we are not going to talk about forecasts, and we are not going to talk how exactly these two guys, owner and buyer, build this estimate of a future profit. But suppose that they are able to do this somehow. And then there are two prices appearing within this transaction. One price is the minimum price an owner is willing to receive or accept, right? Because an owner must have some minimum. I am ready to sell this share or this stock not less than a given price. Again, this is a common sense. When you are selling something, you must keep in mind what is the minimum acceptable amount that you are willing to accept. And it depends on expectations, on her expectations of the future cash flows and risk. Another estimate comes from a buyer, but buyer must have some ceiling, right? Some maximum price that he or she is willing to pay. And again, it depends on her expectations of future cash flows and risk. So we have two different people, and these two different people potentially may have different expectations regarding the cash flows and risk. When the transaction occurs, so one guy has the minimum price, acceptable price, another guy has the maximum price. When the transaction occurs, when owner would sell this stock or shares to buyer, what condition must hold? So the seller has the estimate of the minimum price. The buyer has the estimate of the maximum price. When the real transaction happens, what must be the condition for the real transaction to happen? Guys, this is a common sense. Even kids from school must be able to answer this question. So, the transaction occurs when the two prices either coincide, well, at least they must be equal, or when the willingness to pay exceeds the willingness to buy. The transaction occurs. Willingness to, not to buy, sorry, yeah, willingness to receive. Willingness to pay must exceed the willingness to receive. Okay, now the next important question here, I'm kind of introducing you why we are doing what we are doing, is how technically buyer and seller should translate the expected cash flows into their stock price estimates. So there is a future profit. They estimated this future profit somehow. They have some beliefs about it. They have some forecasts of it. Now, how this future profit is converted mathematically, formally, into the stock price estimate for the seller and for the buyer. And there is a rule. This is the fundamental thing for finance and for many related things. The current asset price, so by asset we mean stock, bond, futures, options, investment projects, gold, currency, whatever you can use, real estate, whatever you can use as an investment. The current asset price depends on the expected future cash flow generated by this asset and the risk associated with the cash flow. We must somehow incorporate future cash flows expected from this asset risk together, and we need to convert this formally, mathematically, in the estimate of the current stock price. Yes, we should have a formal mathematical toolbox to justify current stock price based on these two factors, expected future cash flows and risk. And the logic behind all of this says the following. The basic principle of finance that you must remember at least for this course, but at most for all your life. Like a dollar today, ruble, yuan, whatever, is worth more than a dollar tomorrow. It has nothing to do with inflation. No, it is not about inflation. It is about your investment opportunities. If you are offered the choice between $100 today and $100 next year, well, I guess everyone would answer me that they prefer $100 today. Why? You can take this money and you can immediately invest this 100 and receive a profit. And next year, instead of 100, you expect to have 100 plus something, 105, 110, 120, 101, but not 100. So therefore, 100 next year will be definitely less than 100 today plus some investment opportunity. Again, this is not about inflation. Forget about inflation. You cannot change inflation. What is about financial decisions is about your investment opportunities. If you choose to receive 100 today, you can take this amount and you have an opportunity to invest it and receive more next year, at least 101. And this is definitely larger than 100 offered next year. So, and this says us that we cannot directly compare money in different moments of time. 100 today and 100 next year are not comparable because 100 today can bring you more than 100 tomorrow. So we will introduce this lecture and next lecture this formal mathematical toolbox, how we translate money from the future to the present, from the present to the future, and how we do that in different cases, in different practical applications. And then we will just apply this mathematical toolbox throughout the whole course. So a very simple starting case, one period case. We have today and some amount of money today that we called present value. We have tomorrow, might be next year, next month, next day, whatever. One period tomorrow. And amount of money, which is called future value. When we translate current amount into the future, the process is called compounding. And this is just a simple calculation how much you will receive if you invest today that much. The reverse procedure, which is less obvious, but which is used in most of the financial applications, is called discounting. You have probably heard about discounting in your courses of financial analysis, maybe statement, maybe if you had something like investment valuation, investment project valuation, you also heard something about discounting. If not, well, this is the time when we introduce the discount. Again, you expect something in the future and you want to translate this amount of money into the current value or present value. So, yes, here are the comments. Future value is computed when you want to compute how much you can expect if you invest PV now. This is a type, if you invest. Present value is computed when you want to compute how much you need to invest today to produce future value in the future. The reverse. I know how much I want to receive in the future, and I'm calculating how much I need to invest right now. This is one particular application of it. So now, formally, mathematically, how these two variables depend on each other. We can write something like this. Future value must be present value plus delta. Going back to the previous slide, I said if you receive something today, 100, you must be able to add something to it till the next period. This is your opportunity. It doesn't mean that you necessarily will add something, but in principle, you must have this opportunity. You must be able to do that. You can put your money in bank and receive like 1, 2, 3, 4%. This is your delta. You have this opportunity. And the future value consists of these two parts. Present value plus delta. If you represent this delta formally as a fraction of present value, look, present value times R. Nothing prevents us from this. I can say, well, this delta is a fraction of present value. R is a fraction here. And then what? And then I just factor present value out. And I have this. Present value times 1 plus R is a future value. And this is how compounding is done for this one period case. Well, if I want to apply discounting procedure, I do the reverse thing. I need to express present value in terms of FV and R, which is here. Present value is future value multiplied by this ratio, 1 over 1 plus R. Very simple thing. Everyone studied mathematics in school, and everyone must be able to apply this somehow. And 2 years ago, we did statistics, which is much more difficult than this. Okay, here is an example. Please calculate and tell me what is the answer. So, if you expect to sell a stock for 160 Hong Kong dollars and you require 10%, well, how much you are ready to pay? This is your readiness to pay, right? So this is your maximum possible price that you're willing to pay. This is gonna be the following calculation: 160 divided by 1 plus 10%, which is 145.45. Yes, so this is your maximum amount you're ready to pay for this stock, which is basically must be related to our discussion about how a potential buyer translates the future cash flow into the current estimate of a maximum stock price. Well, this is the way how, in the most simplest case, you can do that. Now, this buyer will go to the market with this estimate, and if there is a seller who is ready to sell at the price less than 145, well, then they will meet each other and they will agree on this transaction. Okay, good. Usually, in reality, we have slightly extended version of that. We have a multi-period case. So when between present value and future value, there are n compounding periods. Not one, but many. And the thing is that when there are more than one period, you earn interest on both initial investment and the previous year's interests. So all the previous year interests are added to your investment, and that's where the compounding thing comes. Well, every next period, your base increases and the wealth grows at a compound rate. And the interest is called compound interest. So formally, we do the following. If you want to calculate the future value, then we take one step, and this is gonna be the calculation of the future value only for the end of the first period, right? At the end of the first period, we have this. Then next period comes and we multiply this again by 1 plus r. And this is going to be the result in the end of the second period. Then we multiply again. This is the result in the end of the third period. And we repeat this again and again until the last nth period of time here. Well, when we have this series of multiplications, we can simplify this with the power. So this is basically present value multiplied by 1 plus r to the power of n. And when we do the reverse procedure, this is simply future value divided by 1 plus r to the power of n. I hope it must be familiar to most of you from mathematics in school or maybe some other courses. Examples. We have 4% compounded annually. You invest 10,000 rubles for 5 years. So how much you expect to receive? Please make a calculations and write me answers to chat. So how should we calculate it? Applying the formula we discussed, we multiply 10,000 by 1 plus 4% to the power of 5 here, and the result is 12,166.53. Good. And the reverse procedure, you expect that in 10 years you can sell the antique vase at 10 million United States dollars. your required return is 15% per annum. The vase is currently sold at the auction. What is going to be your maximum price you're ready to pay for it? So let's accelerate slightly because we need to fit on time. So the present value is going to be calculated applying the reverse procedure. We multiply 10 by this discount coefficient, 1 over 1 plus 15% to the power of 10. So here, and finally 247 million USD is our estimate of the maximum price that we are ready to pay for this vase. Again, the same application comes next. You take this maximum price, you go to the market and you bargain with the seller about the price. If a seller is ready to sell at the lower price, then you will agree, otherwise not. So this is the maximum amount you're ready to pay. Some details to understand the things and what we are talking about. Look, I stressed some important things here to understand. If you expect, so we are talking about expectations. Again, nobody guarantees you that something will be received in the future. If you expect some amount in the future, we denote this with future value. And if you require, so this is your requirement, some return, which we denote with R. So please be careful with the terminology here. This is the, let's say, most applicable terminology. Expect something and require a return. Then you are willing to pay at most present value today. You are willing, you are ready, if you want, to pay at most this amount. We are not talking about the exact price. We are not talking about the guaranteed price. We are talking about your willingness to pay something. If your expectation is future value, if your requirement is R, then you are ready to pay present value today. This is the meaning of present value. This is what we are calculating. So please be careful with this. You must understand this. Not only mathematics, also the meaningful thing. So here you can see what changes if we invest $100 at different interest rates. 0% it's flat, 5% you see that $100 invested at 5% rises to something like 200 in 20 years. At 10% you see that it rises 3 times more, from 200 to 600, and if you invest at 15%, the increase is very fast. So the reaction of a future value on the interest rate is non-linear. And this is the effect of compounding, exactly because of the compounding. So you increase evenly interest rate from 0 to 5, from 5 to 10, from 10 to 15. So this is a linear increase in the interest rate, right? So every time interest rate increases by 5%. But the final result is non-linearly dependent, right? So the final result increases faster and faster and faster. First time it increases from 100 to 200, then from 200 to almost 600, 3 times more, and then from 600 to 1,600. So it's like 3 times, yeah. So this is the effect of compounding. The higher the interest rate, the faster your savings will grow. Again, this is obvious, but just a visual representation of it. And the reverse thing, how present value is affected by the interest rate. Again, if the interest rate is zero, your present value over time is constant. Once interest rate is 5%, you see that present value goes down, and the higher the interest rate is, the faster and faster the present value drops. What is interesting here that the final result for 5, 10, and 15% differs again non-linearly. But look, let's compare. What is the distance between future value at 5% and future value at 0%? The distance is small. Then the distance is larger between 5 and 10%, and 10% and 50%, the distance is largest. For the present value, we observe completely opposite thing. Look, for the present value, the largest distance is from 0 to 5. Smaller, considerably smaller difference between 5 and 10. And from 10 and 5, 15, the distance is not very large, right? So keep in mind that even small discounting brings you large difference in the long period of time. Well, basically, initially, 10 years, the difference is also large. So keep in mind this reaction. The longer you have to wait for your money, the lower its present value, and the higher is the required return, the lower is the present value, but the reaction is non-linearly kind of decreases. Because you cannot go less than 0. That's the thing. You cannot get less than 0, so that's why all these lines will asymptotically go to 0. The last case for this lecture, and the most important for our future discussion, is the case of multiple cash flows. What we should understand. So present values are expressed in current monetary units. So present value is always computed today, at this moment of time. And because of this, we can add present values. We are not able to add cash flows in different moments of time. But once you translated future value into the present value, you are able to add this present value with some other present value. This is the rule. Guys, even if you don't understand why, just take it as given. This is the rule. You cannot add money located in different moments of time. You cannot add $100 today and $100 next year. It's not possible. You need to translate either current money into the future, or you need to translate future money into the present value, and then you are able to add them. Again, if you don't understand why, just remember and don't do this. So the present value is possible to add, and the present value of a cash flow, let's say A and B, is going to be equal to the present value of A plus present value of B. Therefore, we need to establish some mechanism how we can add cash flows in the case of multiple elements. And we have to compute individually future values or present values depending on our goal for every element of the cash flow stream, and then we need to sum over the results. So this is the algorithm, the idea, and now we will see how this works. So first I will show you, so I will not ask you to calculate it, I will show you the most logical way how to make these computations. I guess even if I give this task to the school kids, They must be able to calculate it without any knowledge of time value of money, financial management, financial mathematics, and related things. So suppose you invest 10,000 rubles in a bank account that pays interest of 10% a year. Next year, you add 20,000. In the beginning of year 3, you add 30,000. How much you will earn in the end of the third year? Well, you must be careful to the timing of such tasks because you invest now, next year you add 20,000, and next year you add 30,000. And the result must be calculated in the end of the third year. So I guess for everyone it is obvious that you cannot say, well, it's 10,000 plus 20,000 plus 30,000. No. You cannot simply add these three numbers. Why? Because there is an interest. Every period you earn 10% on the amount that was in the beginning of the year. So this is why we cannot add money located in different moments of time. Let's see. The most intuitive and logical solution. How should we calculate it? If I would give it to some person who is not familiar to the financial mathematics. First year, what is going to be the result? 10,000 multiplied by 1.1, 11,000. Right, so that's what you have in the end of the first year. Then 20,000 is added to 11,000 and you earn 10% once more. 34,100. And the third year, this amount you add 30,000 and earn 10% once again. In total, you have 70,510 rubles. So this is the way how you would intuitively calculate the result. What's the problem with this? This is kind of like recursive steps, right? So you need every year recalculate your result, and this is too long. Assume that we have 100 periods and you need to recompute 100 times all these things. You cannot automate this, even with the help of Excel. You cannot automate this process because it's, well, it's not that suitable. Can we generalize this somehow? And can we use something from the previous discussion, from the previous slides? The answer is yes. Yeah, Liao Xin does a very strange thing. You add money, the same amount several times. Well, Liao Xin, you cannot add 11,000 with 34,000. First of all, 11,000 is in the end of the first year. 34,000 is in the end of the second year. This is the first mistake. 5 minutes ago, I said that it is not possible, it is forbidden to add money located in different moments of time. Liao Xin demonstrates immediately how attentive he is to my words. This is first thing. Second thing is, look, 10,000 is the part of 11,000, right? So you invested this 10,000 and this is the part of 11,000. And 10,000 is a part of 34,000. This is the magic. I guess, okay, I wish I could find such bank that will double my money every year. Because 10,000 here, it's my investment. And then Liao Xin proposes that the bank will give me 10,000 again. Right? So adding these two numbers. Well, reality is not this brilliant, not that beautiful and bright. And in reality, bank will not double your money. The bank will say, well, you invested 10,000, you earned 10% here, and then on the same 10,000, you earn 10% here. And it's just double counting. And when you add this, it's triple counting. Okay, I hope everyone understands what's the problem. So can we generalize this calculation somehow in order to Liao Xin and other people who want to add all these numbers will explicitly see that it is not possible to add them? Well, we can, let's say, write all this calculation in one line. Let's start with this. So one line will be looking like this. It's 10,000 multiplied by 1.1 plus 20,000, and this is the result in the beginning of the second year, and we earn 10% once again. And then we add 30,000 multiplied by 1.1, and this is a result 70,510. So there is nothing to add now. So we got this result immediately in one line. Now, if we open the brackets, we will get something like this. 10,000 is multiplied by 1.1 3 times here. And this is the future value separately of 10,000 of my first amount I invested. Plus 20,000 multiplied by 1.1 to the power of 2, because 20,000 was there for 2 years, for 2 periods. Then 30,000 multiplied by 1.1. Well, sorry, this is a typo. Must be the first. So 30,000 multiplied by 1.1. Nothing here. So yeah, this is a typo. Equals the same. And now this formula allows us to generalize. Yeah, let's do like this. Allows us to generalize the whole procedure. Because what's going on right now? If we want to generalize this for n periods, we will take the first element, which is located in period 0, right? So today, at the moment 0, multiply this by 1 plus r to the power of n, plus the next payment multiplied by 1 plus r to the power of n minus 1, plus blah, blah, blah. We continue doing this, and then the last one is multiplied by 1 plus r to the power of 1. Like here. Or we can wrap this to a simple formula like this. With sum over elements of this multiple cash flow multiplied by 1 plus r to the power of n minus t, t from 0 to n, or maybe to n minus 1, so it depends on the situation. So basically it's not a mistake. It depends where you start. If you start from 0, that's gonna be like this. If you start from 1, that's gonna be if you start from 0, it ends it starts from 0, and if it ends in n minus 1, it's gonna be n minus 1. So again, you cannot generalize this to all the situations, but it depends on the particular case. This is the scheme, what's going on. Look, this is time. These are the elements of our cash flow, and these are the this is the calculation, how we calculate. The indices must be 0, 1, 2, and n minus 1. Sorry, the indexation is not the same as I used on the previous slide, but I guess the logic is clear what's going on. And the reverse procedure. The reverse procedure is about the present value of a stream of cash flows. I'm showing you one particular example where we are using this present value of stream of cash flows. We are willing to run a business, and the forecast shows that we can expect, again, we are talking about expectations, following cash flows in the next 4 years. So 10, 15, 20, 25 million rubles. So those are our return that we are expecting from the business, what we can receive back from the investment. Our requirement is 20% on investments, how much we can invest into this business. There's extra U here and no U here. Again, in principle, we can apply the straightforward solution, which is not optimal, and you don't need to remember this. I'm just trying to show you the link that this is related to something logical. Sometimes people, when you show them present value calculation, they are not they do not see why the calculation takes place like this. So that's why I prefer to show you how this calculation can be done without any knowledge of financial mathematics, and then we will go to the formal, financially correct calculation. So the straightforward solution is this. I invest X. First year, I require to earn 20% on top of my investment, on top of my X. In the end of the first year, my business is expected to pay me back 10. Pay back. I am not adding something, I am receiving back. So that's why it's gonna be minus 10. So I invested X. I require on top of X for the first year to receive 20%. And then business gives me back 10. So this is my amount still invested or locked in the business in the beginning of the second year. So in the second year, I still require 20% on top. And over the second year, the business pays me back 15. And I continue doing this again and again until what happens? Until the last amount is paid back and I receive nothing. So there is nothing left to receive back. So all my investment with all my required return has been received back. Well, I need to express X from here. I need to open brackets and I will get something like this. X times 1.2 to the power of 4 minus 10 times 1.2 to the power of 3, blah, blah, blah. So I get this equation. Now I am able to express X. And now interesting things happen. X equals 2 on the next slide to the present value of this stream of cash flows. Look, if I want to express X, all these terms go to the right with pluses. And then I divide every term by 1.2 to the power of 4. What I receive? 10 over 1.2 to the power of 1. Present value of the first element. We know how to calculate present value of one element of one cash flow. So this is the present value of the first element expected in the end of the first year. This is the present value of the second element expected in the end of the second year. This is the present value of the third element expected in the end of the third year. And this is the present value of the fourth element expected in the end of the fourth year. So I calculate separately present values of every element located in different moments of time, and then I am able to sum over them. And this is formally correct. This is the result. And the meaning of this result is the same as we discussed in previous two examples. This is the maximum amount that I am willing to invest into this business if my expectations are this and if my required return is this. Nothing is different in the meaning. If we generalize this to n periods, we will have something like this. C1 over 1 plus r to the power of 1, C2 over 1 plus r to the power of 2, plus blah blah blah, Cn over 1 plus r to the power of n. No plus here, yeah, shouldn't be. And then we sum over these elements. Well, again, t from 1 to n or t from 0 to n doesn't matter much. It depends on your particular situation. And the scheme, how we compute this present value. We have time, we have elements of the cash flow, and for every element we calculate or we compute the present value individually and then sum over them in order to receive the present value of this stream of cash flows. Any questions to me? That's what we are gonna do practically next week during the exercise sessions. You will have some tasks, some exercises, and you need to solve similar problems. Any questions? Anything that is not clear from what we had before? I will definitely correct all the typos and I will update the slides on the course page. So don't worry. Everything
I
is
think
gonna
it's
be
all clear.
updated. Okay. So to conclude, very important thing, please remember, you can operate, compare, add, subtract, do any other mathematical operations, cash flows, only when they are at the same moment of time. Be very careful with this. If we are talking about money today and money 3 years afterwards, we cannot directly add them, subtract, compare, we can do nothing. We need to translate them either into the present value or into the future value. So 1000 rubles today and 1200 rubles in 1 year are not directly comparable. You cannot say that 120 is greater than 1000. So suppose that there is some bank that offers you 30% annual interest rate. If there is such an opportunity with 30%, you will receive 1300 next year, and 1300 is greater than 1200. So in this sense, 1000 today is greater than 1200 tomorrow or next year, because there is also this investment opportunity. But if there is only one opportunity to invest 1000 at 10%, then 1000 is going to be less than 1200, but not directly. You would say, well, 1000 times 10% gives me 1100, and that is why this amount is less than this. That's the way how you need to compare money in different moments of time. Yes, you need to estimate the future expected results. Calculate future value. If you need to calculate the maximum acceptable price for the investment, calculate the present value. And the last thing is about home assignment. I showed you that the home assignment is going to be available no, till not September 21st, September 25th, so Sunday. Trust to the date that is shown on the course page. And what's gonna be there? So you will be given some public company from one of the BRICS countries, like we did on the exercise session. So randomly you will get some name like Alibaba, Rosneft, Petrobras, maybe some Indian companies, whatever. You need to write a short description of the corporate governance system of this company. So you go to the website, you open the web page, and you do this characteristic in the way that we did during the exercise session. So what is important, guys? Once again, I will repeat this probably every lecture. Provide your personal opinion on the quality of the corporate governance. Don't copy text from their web pages. Don't copy text from the internet. It must be your genuine answer. And please be specific. So this lecture I showed you what is specific and what is not specific. And always support your opinion with some solid arguments. Don't be too vague in your answers. Don't digress from the question somewhere else. Don't speculate on, I don't know, state of economy of the country, industry, and whatever. Specifically, practically. Think like you need to give some investment recommendation to your friend, to your parents, to yourself. Somebody asks you, well, you are the professional. You have listened to financial management course. Please explain me simply and with arguments why corporate governance of this company is good and protects my shareholder rights, or why corporate governance is not good, what are the risks for my shareholder rights. That's the way how you must answer. And the very last thing, do not use translators. Again, if I don't understand what you mean or what translator means, this is your problem, not mine. Write with simple phrases and simple, commonly used words. Translators work poorly. It is better to use your own language, simple but understandable, than to use these sophisticated translators. Trust me, they are poorly trained to translate from Chinese to English. The result is very bad. Use English, not Chinese. Questions?
No question. Thank you, Professor.
If there are no questions, then thanks. With the second group, we had the exercise session before the lecture, so there is no class afterwards, and see you next Saturday. Don't forget about home assignment. Bye bye, guys.
See you, Professor.